What's good, everybody? Welcome to the Financial Freedom Show with Chase Lawson. I'm your host, Chase Lawson, personal finance enthusiast and the author of Financial Freedom, Breaking the Chains to Independence and Creating Massive Wealth. We have another great episode in store for you today, so I hope you're as excited as I am. This topic actually was requested from one of my listeners, so like I always say, if there's a topic you want me to address, I am more than willing to do so. So in today's episode, I will be tackling the topic of IRAs. IRAs can be a little complicated, so my goal, as always, is to try and make it as simple as I can for you to understand. There are 5 main topics I plan to cover today, including the differences between an IRA and a 401k, the 2 primary types of IRAs, the differences between each type, the tax rules associated with them, and how they can be a beneficial part of your investment and retirement savings strategy. So let's get started. So first off, if you haven't yet checked out my episode on what is a 401k, I would encourage you to check it out after you finish this episode. An IRA and a 401k are pretty similar. Both are retirement accounts and have special tax incentives associated with them to encourage individuals to put away money for their retirement. And while 401ks are becoming more and more common in the American workplace, there are still many who may not be offered a 401k through work, or if they are, their employer may not offer a match. If this is the case, they may be limited to only an IRA for their retirement qualified accounts. So first of all, what even is an IRA? An IRA is an individual retirement account, whereas a 401k is an employer-sponsored plan. An IRA is typically managed yourself outside of your employer. Therefore, while a 401k will deduct money from your paycheck and divert those funds directly to your 401k investments, an IRA is something you will have to be more proactive in setting up and funding yourself. One of the downfalls typically with 401ks is that they can often be very limited in their selections. Since a 401k is managed through your employer will decide which investments, such as specific mutual or index funds, are able to be invested in for your 401k. Some companies offer a wider selection than others, but this is a big limitation. An IRA is an account you can set up with any taxable brokerage like Vanguard or Fidelity, through robo-advisors like Wealthfront, or even through many banks, and your investment selection is essentially limitless. As long as the brokerage offers a specific investment for purchase, you can invest your IRA dollars into that investment or investments. As a result, you have a wider selection and can invest in individual stocks, mutual funds, index funds, ETFs, bonds, CDs, and even real estate, along with some other investment options. The other main difference between a 401k and an IRA is contribution limits. This is one major benefit of 401k plans, in that you can contribute more each year to a 401k than you can an IRA. The IRS currently allows individuals to contribute up to $19,500 per year into a 401k, or $26,000 per year if they're 50 and older. This is just for your personal contribution, so if your employer offers a match, you can contribute $19,500 on top of what your employer contributes on your behalf. However, with IRAs, you're only allowed to contribute $6,000 per year across all IRAs, or $7,000 if aged 50 and older. You have until tax day of the following year to make a contribution for a given year. For example, in 2020, tax day was extended to July 15th, so you could have made a 2019 contribution of $6,000 up to July 15th, 2020, and you have until next year's tax deadline of April 15th, 2021 to make your up to $6,000 2020 contribution. So while you have more options with an IRA, you can't contribute as much in any one year than you can with a 401k. The other big downside to an IRA compared to a 401k is that you don't get a free match with an IRA, whereas most employers who offer a 401k offer some sort of match, usually a certain percentage of the first 6% of your salary you contribute. This is usually between a 50 and 100% match, so that's an instant free 50 to 100% return on your investment with a 401k. If your employer does offer this, even with limited investment selection, this is still something to take advantage of and try to max out the amount they match each year, as not often can you get that kind of return on an investment. However, if your employer does not offer a match, I would advise starting with your IRA and maxing that out first, and then funding any remaining amount you are comfortable saving for retirement to your 401k. That way you're still saving for retirement while giving yourself plenty of options for investing. Those are the primary differences between a 401k and an IRA. Just like with 401ks, there are two main types of IRAs, a traditional IRA and a Roth IRA. Traditional means pre-tax and Roth means post-tax. The difference though with an IRA is that you contribute money after you already were taxed on it. So what the IRS does is it essentially gives you an option. You can either take your contribution and deduct it from your income for the year you contributed for, or you can decide not to take the tax deduction up front with the Roth and instead withdraw it later on tax-free. As an example, let's say your taxable income is $50,000 before accounting for your IRA contribution, and you make the full $6,000 IRA contribution in a given year. If that contribution was in a traditional IRA, you would deduct the $6,000 from your $50,000 to get $44,000 in taxable income. For a single tax filer, this would save you $1,320 in taxes in 2020 based on your marginal tax rate. Since you choose to take the tax deduction up front, you will be taxed whenever you do withdraw that money several years from now on the full amount of the withdrawal, including on any earnings generated from that money based on whatever your future tax rate is. On the other hand, there's a Roth IRA. In this same scenario, if your $6,000 contribution was in a Roth IRA, you essentially are making that contribution after tax, meaning your taxable income this year is still $50,000 and you don't save that $1,320 in taxes this year. However, the great thing about a Roth IRA is that when you do withdraw that money in several years, you don't owe any further taxes on it, not even on the earnings generated. So if that $6,000 grows to $24,000 and then you withdraw that full amount in retirement, you don't owe another dime in taxes. Whereas with a traditional IRA, since you chose to take the tax deduction up front, you're responsible for taxes on the full amount at withdrawal, which if you're still in the 22% tax bracket would mean $5,280 in taxes. And as Ty and I discussed in the episode on 5 lessons learned for managing $1 billion, taxes are expected by most to increase in the future since we're at historically low rates currently. So by utilizing a Roth, you could end up saving more money in taxes by paying the taxes today while they're at such a low rate before they increase. If you've been following along so far, everything should make sense, at least at a high level. In theory, they are pretty easy to understand. IRAs, both traditional and Roth, are both retirement vehicles that offer tax savings. Because if you invest that same money in a taxable brokerage account, you pay the taxes on the money up front when you earn it, prior to contribution, and then again when you withdraw on the earnings made. But with IRAs, you either pay taxes up front on the initial contribution with a Roth and none on the earnings, or you pay no taxes up front and then taxes get deferred to withdrawal with a traditional. So you only pay taxes once as opposed to twice with non-retirement investment vehicles. Once again, you're allowed to contribute up to $6,000 per tax year total across all IRAs you hold. There are some important rules, however, to keep in mind with IRAs that can be a little more complicated to keep track of. I will do my best to break it down for you. The first rule is that you can only contribute to an IRA if you have earned income and can contribute the lesser of your earned income or $6,000 per year. So if you only make $4,000 in income in a given year, you can only contribute $4,000 to an IRA that year. However, if you do not work, or if you work and make less than $6,000 and are married, your spouse can contribute to an IRA on your behalf as long as combined you both earn at least $12,000 in income for the year. So for most people, this probably isn't an issue, but if you're currently in college or retired or out of work, you may not be able to contribute to an IRA. Earned income includes things like salary, wages, commissions, professional fees, bonuses, taxable combat pay, jury fees, accrued vacation pay, and more, as long as it is included in box 1 of your W-2. On the other hand, pension and annuity payments, payments from IRAs or company retirement plans, Social Security benefits, as well as royalties, interest income, dividends, and other capital gains, life insurance proceeds, disability and unemployment payments, child support, and rental income do not count as earned income for the purposes of determining if you can contribute to an IRA. A second rule to keep in mind with IRAs is that you may not be allowed the full deduction for a traditional IRA contribution. This depends on if you are offered a retirement plan, such as a 401k, through your employer, and on your income. Regardless of your tax filing status, if neither you nor your spouse are covered by a plan at work, meaning you and your spouse either aren't offered a retirement plan at work or don't contribute, you can take a full deduction for your IRA contribution regardless of income. However, if you are covered by a work plan, the IRS has rules in place to limit who can take a deduction, since you already are potentially benefiting from a deduction with your work plan. If you're single, you can take the full deduction if your income is $65,000 or less. This then gets phased out gradually until you get to $75,000 or more in income, at which point you are not allowed a deduction at all for a traditional IRA. If you are married filing jointly and you are covered by a plan at work, you are allowed the full deduction if you and your spouse make $104,000 or less for the year, a partial deduction of between $104,000 and $124,000, and no deduction if $124,000 or more. And if you file married filing jointly and your spouse is covered by a plan at work, you can take the full deduction if combined income is $196,000 or less, but once it exceeds $206,000, you aren't allowed a deduction at all. So as an example, let's say you bring in $90,000 a year, your spouse brings in $50,000 a year, you are covered by a work plan, but your spouse isn't, and you file married filing jointly. Your combined income is $140,000. Since you are covered by a plan at work, you aren't allowed a deduction for a traditional IRA since your combined income is over $124,000. However, your spouse is allowed a full deduction for a traditional IRA since combined income is less than $196,000. So your spouse can contribute $6,000 to his or her traditional IRA and use the full amount to deduct from your taxable income, reducing taxable income by $6,000. But if you were to also contribute $6,000 to a traditional IRA, you can do so, but you just can't take the tax deduction on it. So you will still pay taxes on your contribution and again at withdrawal. Finally, if you are married filing separately and either you or your spouse is covered by a plan at work, you are not allowed a deduction if your income is $10,000 or more. That is for a traditional IRA. I personally am a fan of the Roth IRA since it could lead to less money in taxes paid if taxes do increase in the future, along with a couple of other reasons I'll mention in a bit. However, the IRS also has rules as to who can contribute to a Roth IRA. The IRS basically has said that if you earn too much money, you cannot contribute to a Roth IRA. This again is based on income and filing status. If you're single or head of household, you can contribute the full $6,000 if you make less than $124,000. This is then reduced gradually until you hit $139,000 in income, at which point you are ineligible from contributing to a Roth IRA. If you're married filing jointly or a qualifying widow or widower, you can contribute the full $6,000 if your combined income is less than $196,000, or a reduced amount until $206,000, after which you are not eligible. Finally, if married filing separately and you live with your spouse at any time during the year, you can contribute a reduced amount to a Roth IRA until your income hits $10,000, after which time you are not eligible to contribute. So that can be a little complicated and a little hard to explain. Obviously, the more money you make, the less likely you are to be able to take advantage of either of these accounts directly. However, there is still a way for high income earners to take advantage of the tax benefits offered by an IRA. That is through what is known as a backdoor Roth IRA. This is a tax loophole that lets high earners contribute indirectly to a Roth IRA, because remember, once your income exceeds a certain threshold, you cannot contribute directly to a Roth IRA, and you are not allowed the deduction for a traditional IRA. This approach is important to know and can lead to tens or even hundreds of thousands of dollars saved in taxes over the years. Here's how it works. First, you open a traditional IRA, or use one you already have if you've already opened one. After opening the traditional IRA, open a Roth IRA. You should be able to do this with the same brokerage or bank used to open your traditional IRA. Then fund the traditional IRA. Once again, you're allowed to contribute up to $6,000 per year if under 50. So if your income is too high to contribute to a Roth, it's also too high to deduct the traditional IRA contributions from your tax bill if you or your spouse contributes to a retirement plan at work. Therefore, you're already putting after-tax dollars into your traditional IRA. Once that money is in the traditional IRA, convert it over to your Roth IRA. It is important to do this right away so that you don't contribute an excess amount in the event your traditional IRA balance grew above $6,000. If unsure how to do this, you should be able to call the financial institution you're handling this through, and they can walk you through the process, but there should be an option once the money is funded to convert it directly from your traditional IRA. Then just repeat the same process every year moving forward, except once you have the accounts opened, you won't have to go through the process of opening a new account each year. This way, you paid taxes up front, still contributed to a Roth IRA through the back door, and your account will then grow tax-free, and you will owe no taxes once you do withdraw the money in retirement. There are other benefits to a Roth IRA over traditional IRA as well. I personally contribute to a Roth IRA because I do feel the benefits far outweigh that of a traditional IRA. Not only does a Roth IRA protect you from future tax increases, and not only is that money tax-free at distribution, but there are other benefits to a Roth IRA as well. For one, unlike 401ks and traditional IRAs, you can withdraw your contributions at any time with a Roth IRA. For example, say you contributed $6,000 this year to a Roth IRA and it grows to $10,000 next year. If desired, you could withdraw up to $6,000 tax and penalty free next year and leave the other $4,000 in the account. This certainly isn't recommended as it is still a retirement account and it is ideal to let it sit and grow until retirement, but if needed, you could pull that money out and pay no taxes or penalties on it. With a 401k or traditional IRA, aside from a few exceptions, you cannot withdraw any money from those accounts until age 59 and a half, or else you'll be subject to taxes and a 10% penalty on the amount withdrawn. And the IRS treats Roth IRA distributions favorably. The IRS has said that contributions are always deemed to be withdrawn first. Earnings are not considered distributed until you've withdrawn the full amount of all contributions and then all conversions. So if you need the money before retirement, you can pull out your contributions from a Roth IRA early without any taxes or penalties. The next benefit to a Roth IRA is tax treatment in retirement. With traditional IRAs and 401ks, distributions are taxed as ordinary income in retirement. Whereas with Roth IRAs, the distributions are tax-free as long as the account was open for at least 5 years. And when I say in retirement, I mean at age 59 and a half or later. So contributions to a Roth IRA can be withdrawn at any time, tax and fee free, and the earnings can be withdrawn after age 59 and a half, tax and fee free, as long as the account has been open for at least 5 years. So if you make your first contribution at age 58, you can pull out earnings once you hit age 63. A final benefit of Roth IRAs is that there are no required minimum distributions in retirement, meaning you can continue to let the account grow and pass it on to your kids if desired after you die without ever having taken any withdrawals. For some people, it is important that they leave money behind for the next generation, so this is a major plus. However, even if that is not your goal, it can be good knowing that you aren't required to take out a certain amount each year if you want to let it grow. With 401ks and traditional IRAs, you are required to start taking out a certain minimum amount once you hit age 72. This is very important to know too, because RMDs, or required minimum distributions, can be complicated to understand, and if you fail to take the full amount of the RMD on time, you can get hit with a 50% tax penalty. So if your RMD was $10,000 in a given year and you failed to take that distribution because you didn't know you had to, you will owe $5,000 in penalties. So hopefully you guys were able to understand the key benefits and the differences between the different types of IRAs. As I mentioned, the rules and tax implications can be a bit confusing, and there are a lot of numbers to keep in mind. Don't let it be complicated. If you know your income and your tax filing status, that will help you determine what type of IRA you can have and whether you need to utilize a backdoor Roth or can just contribute directly to a Roth. Once again, an IRA is an important part of your tax planning strategy. Having money in different types of accounts can be helpful so that you have money for the short term, medium term, and long term, and can pull out money in the most tax efficient manner when it is needed. And once again, I do advocate having both a 401k and an IRA, as both are great retirement vehicles. I personally prefer Roth plans on both, but if you'd rather save on taxes today and pay taxes down the road, traditional may be the move for you. I can only advise what the main advantages and disadvantages are to each. You have to actually make that decision for yourself. If your employer does offer a match on 401k contributions, start there, as that is free money. If not, start with an IRA until you max that out and then contribute to your 401k. And most importantly of all, once the accounts are funded, you do have to pick which investment or investments to invest in with those funds. So don't forget that all important final step when you set up your IRA. Thanks so much for tuning in to today's episode of the Financial Freedom Show with Chase Lawson. I hope you enjoyed it. IRAs are a great thing to know, understand, and utilize. If you still have questions, perhaps listen to this episode again, or feel free to leave a comment below and let me know your questions. I want to make this as simple and easy to understand as I can so that you feel prepared to take full advantage of this offering. Please be sure to let me know your thoughts as well, or if there's any other financial topics I can cover for you. Thanks again to the listener who asked me to cover this topic. And as always, please be sure to like this episode or leave a review if you got value out of it, and make sure you subscribe and share with others so that you and your loved ones can all stay up to date with the latest content. I do this for all of you, so your feedback is super important and helpful. Thanks so much, everyone, and until next time, stay safe and go get them.